Hi, my name is Barry Weber, and I'm a CPA and attorney in the Fresno, California area. And the purpose of this short webinar is to introduce you to the new tax rules that go into effect as for in 2018 as they relate to individual taxpayers. Now, this is just an introduction to the basic concepts. It's not intended to be comprehensive, and it's not intended to be legal advice or form an attorney-client relationship with you. The effective dates of most of the changes apply in the tax years beginning in 2018. So that means that it won't affect your 2017 return that you file in 2018 will affect later returns. The individual tax changes sunset or go away after 12/31/2025 unless they're extended by Congress. There remain 7 individual tax brackets from 10 to 37%. The bottom bracket remains at 10% like before, but the amount that's covered by the bracket doubles to $19,050 for married filing joint returns. The tax rate itself on most brackets is lowered by about 2%. So far, it's mostly good news as far as the tax rates are concerned. There's a change in how tax brackets are increased for inflation, and just know that the increases will be less than what they would have been under the old law. The marriage penalty is eliminated by and large, except for the 37% tax bracket. And the kiddie tax that applies to unearned income by minor children is now taxed at the trust rate instead of the highest individual tax rate. The standard deduction is the big change in the tax law and is increased to $12,000 for individuals and $24,000 for married filing joint returns, which is just about double what it used to be under the old law. Under the old law, the standard deduction phased out for high-income taxpayers. Now there's no phase out of the standard deduction. So fewer and fewer taxpayers will be itemizing their deductions because the standard deduction increased. But the bad news is personal exemptions have been eliminated. There are certain above-the-line deductions, that is, that they're taken before adjusted gross income, that have been eliminated under the new tax law. Moving expenses, except for active duty military, that deduction is gone. Alimony payments were deductible to the payor and income to the payee. Now they are not deductible and not income to the payee. But this only applies to divorce decrees dated after 2018. So any of those old divorce decrees, including ones that are entered into this year, the old law still applies. Itemized deductions. There's changes in the amounts of itemized deductions. The medical expense deduction, there used to be a 10% floor. That threshold has been lowered to 7.5% of AGI for just 2018 and 2019 tax years, but then returns to 10% thereafter. The state and local income and tax deductions have been limited to $10,000. Under prior law, these deductions were unlimited, and this includes property tax deductions, but does not apply to business and trade taxes paid. Mortgage interest deduction is now limited to $750,000 of total mortgage debt. It used to be $1 million. And HELOC, the home equity lines of credit, that interest is no longer deductible. Now, old purchase money loans are grandfathered in. So if you have a larger purchase money loan that's existing at this time, it will be grandfathered and you can still deduct it under the old rules with some limitations. Casualty losses are no longer deductible unless the casualty loss is in an area declared by the president to be a disaster area. A small change to charitable contributions. Contributions to public charities has increased to 60% of AGI. It used to be 50%. And most of the 2% threshold miscellaneous deductions have been eliminated. So those deductions that you used to be able to take for tax preparation expenses, out-of-pocket job expenses, and the like are no longer deductible. Another big change that's a plus for taxpayers with children is the tax credit. Child tax credit has been increased to $2,000 per qualifying child under the age of 17. And $1,400 of that credit is refundable. So that means if you don't owe any tax, you can actually get a refund. In addition, there's a non-refundable credit of $500 for non-qualifying child dependents. So if you have somebody that doesn't qualify as a dependent for the $2,000 return, but is your dependent, the $500 non-refundable credit is available. The phase-out limits for the child care credit or child tax credit go up substantially to $200 of modified adjusted gross income for singles and $400,000 modified adjusted gross income for married filing joint returns. So the tax credit is increased and it's available to more taxpayers. The individual alternative minimum tax, that other tax system that higher income people had to calculate their tax by, it still applies to individuals, but the exemptions have been raised substantially. And there's a phase out of exemptions for higher income taxpayers, but those phase out thresholds start at a much higher rate now. The 529 educational savings account, there's a couple of changes that are beneficial to taxpayers. The educational savings accounts used to be only for college or graduate students. Now they can be used for K through 12 and homeschool expenses. And a maximum amount per year that a student can use from the 529 account is $10,000. Inheritance taxes, the unified credit has now gone to $11.2 million per person or $22.4 million per couple if they filed married filing joint. That means that very few taxpayers will be subject to gift and inheritance tax under the new law. The ACA individual mandate penalty, that penalty that applied if you didn't have qualified health insurance, goes away in 2019. There's some minor changes to deductions. Employer subsidized parking and transit reimbursements are no longer tax-free to the employees. So if your employer reimburses you for transit expenses, you have to declare it as income now. Like-kind exchanges are still there and still apply, but the personal property exchanges are repealed. So it used to be that you could trade personal property for like-kind property and not have to recognize the tax in the trade year. Now it only applies to real estate. It's unclear how that's going to affect things like car trade-ins, that kind of transactions that are common. The 1031 exchange may qualify still if one of the legs of the exchange happened before 12/31/17. So if your personal property exchange is in place as of the end of last year, you can still qualify. There's a lot of things that didn't change under the law that were batted back and forth. And one of the things that didn't change is the Section 121 sale of personal residence rules. Those rules still stayed the same. The capital gains rates of 0, 15, and 20% long-term capital gains still stays the same, but the brackets change for the income that's included in each bracket. Ordinary income rates apply to any short-term capital gains. The surcharge on net investment income for high-income taxpayers remains at 3.8%. The annual gift exclusion for high-income taxpayers that are concerned about the gift tax is now $15,000 per recipient. There still remains an inheritance stepped-up basis, and the 40% estate tax rate stays. Student loan interest is still deductible under the new law, and educator expenses that can be deducted above the line are still deductible. So I hope that gives you just a basic overview of what some of the changes that are coming down the pipeline for 2018. You can get more information on my website at www.perryweberlaw.com, or shoot me an email or give me a call. My phone number's on the website. I'd be happy to schedule an introductory consultation in person or by telephone. Thank you for watching this webinar.